All right, let's dive right in. Today, we're talking about capital strategy. Now I know, that sounds like a term straight out of a finance textbook, but stick with me, because it's not just a line on a balance sheet. It is the absolute blueprint for a company's future. We're talking about the huge, make-or-break bets that companies make, their CapEx, and how on earth they can get them right in a world that is, let's face it, completely uncertain. The rules of this high-stakes game are changing, big time.
And just to get a sense of the scale here, look at this number. By 2030, analysts estimate that $5 trillion will be poured into clean energy every single year. And that's not even counting the trillions more in CapEx going into AI infrastructure and completely rewiring global supply chains. The stakes for making the right capital decisions, well, they have literally never been higher.
But here's the kicker. For all that money being spent, there's this massive gap between what a strategy promises and what it actually delivers. On average, companies only realize about 63% of their strategy's financial potential. Think about that. That's not a small leak. That's a third of the value, just vanishing into thin air. It points to a really fundamental problem that we have to unpack.
So where does that other 37% go? Now, the easy answer is to blame bad execution, right? But the research shows the problem usually starts way, way earlier. It's not just about doing things right. It's about having the right approach to strategy in the first place, an approach that's actually built for a world that refuses to stand still.
And that brings us to this core conflict. You see, for decades, the playbook was plan, then do. You'd create this incredibly detailed multi-year plan based on a forecast of the future, and then you just execute it like crazy. The problem is that model is totally broken. The winners today, they use an agile decide, do, refine, do approach. They make a call, they act on it, they see what happens, they learn, and then they refine. They're embracing uncertainty instead of pretending it's not there.
So, the first big principle of this new way of thinking is a huge mental shift. You've got to stop thinking of strategy as a single rigid plan and start seeing it as a dynamic portfolio of choices.
This metaphor right here is everything. A bond, it gives you a predictable, pretty much fixed return, safe but boring. An option, though, gives you the right, but not the obligation, to make a much bigger investment later. In a world you can't predict, the flexibility of an option is just so much more valuable than the false security of a bond. And a winning portfolio skillfully blends three types of these moves.
First up, you've got your big bets. These are the bold, go-for-it moves that can totally reshape an industry. You know, building a massive new factory or making a game-changing acquisition. The upside is huge, but they also carry some serious risk if the future doesn't play out the way you think it will. Now, to balance out those big bets, you create options. And this is where it gets really smart. These are smaller, initial investments designed for one thing: learning. We're talking a pilot program, a limited joint venture, maybe licensing some new tech. They let you dip your toe in the water and get real data before you commit massive amounts of capital. For a startup trying to conserve cash, this isn't just a good idea, it's how you survive.
And finally, every good portfolio needs a solid foundation of no-regrets moves. These are the no-brainers, the things that make total sense no matter what the future holds. Stuff like improving your operational efficiency, training your team, or just getting smarter about what your competitors are doing. They make the company stronger, period. A really powerful portfolio has all three working together. Okay, so if the what of strategy is a portfolio, the how is just as critical. And that brings us to our second principle. You need to treat the execution of your capital investments like a dynamic, living supply chain, not like one single giant project. This whole approach really rests on three key pillars. First, you manage the whole thing as an interconnected system, not a bunch of separate tasks. Second, and this one is absolutely crucial, you deliberately build in flexibility by putting off the most expensive, irreversible decisions for as long as you possibly can. And third, you obsess over the small, granular input metrics that actually lead to success, not just the final big picture number.
This idea of different types of decisions is so important. Some are one-way doors. Once you're through, it is incredibly expensive and painful to go back. Think about pouring the concrete foundation for a new, highly specialized factory. But other decisions are two-way doors. They're super easy to reverse, like testing a new price on your website. The real trick is to identify your one-way doors and wait to walk through them until you have the absolute most information you can get.
So this all sounds great in theory, right? But what does it actually look like in the real world? Well, when companies start thinking this way, with a portfolio and a supply chain mindset, it completely transforms how everyone does their job, from marketing and management all the way to finance and entrepreneurship. Let's see how.
Take marketing. The days of betting the entire budget on one giant Big Bang campaign are over. Instead, you run a series of smaller, micro battles. Caesars Entertainment is brilliant at this. They use their casino network to test different promotions on a small scale. If something works, they scale it up. If it flops, no big deal. But it's not just for giants. A startup does the exact same thing when they A/B test a landing page before dropping big money on ads. It's a perfect example of using options to guide your strategy.
For general management, this approach completely changes where leaders put their attention. Instead of getting bogged down in every little detail, they can focus on the parts of a project with the highest risk and the highest reward. Amazon did this perfectly when building out its Air Hub. They bought the land they needed. That's a reversible two-way door decision they could make early, but they held off on the super expensive final outfitting, a classic one-way door, until customer demand was absolutely crystal clear.
And for finance and entrepreneurship, this changes the whole game. Instead of demanding a perfect bond-like forecast for every new idea, they start treating them like call options. Google's parent company, Alphabet, is basically the poster child for this. They make tons of small bets. A lot of them fail and they get shut down fast. But the ones that hit, they get massive follow-on investments. And this isn't just for tech giants. That's the exact same logic every startup founder uses. Place small bets to find what works before you go ask for big money.
So, when you pull all of this together, what does it all mean? Well, it's a completely new way of thinking about how you invest your capital and how you build your strategy. It's a playbook that's built for agility, for resilience, and at the end of the day, for much, much better results, no matter if you're a startup or a Fortune 500 company.
It really all boils down to this: a new playbook with 3 simple rules. Number 1, your strategy is not a rigid plan. It's a living portfolio of big bets, smart options, and no regrets moves. Number 2, your execution is not one giant project. It's a flexible supply chain that you manage for flow. And number 3, in a world that is always changing, flexibility will always be more valuable than a perfect but fragile forecast.
And that leaves us with one final question to think about. I want you to take a hard look at your own organization, whether it's a brand new venture or a global corporation. Is your capital strategy a single, fixed roadmap that's just waiting to be broken by the next surprise? Or is it a dynamic portfolio of possibilities, ready to adapt and win the future, no matter what it holds? The answer could really make all the difference. Thanks for watching.